Hello everyone, Matt Weaver. Okay, let's get to it. All right, a popular topic. Matt, what happens when an appraised value comes in lower than the contracted sale price? All right, let's get right to it. So let's first understand what it looks like when a home buyer is applying for a mortgage. And we're going to use an example here, some easy numbers, okay? So let's assume for a second someone is purchasing a home for $400,000 and they want to put down $200,000, which of course is a lot of money. Now they're applying for what's called a 50% loan to value, meaning we as a lender, we're giving 50% of the value of the home or the proposed value of the home. All right, so now the mortgage lender, of course, orders an appraisal. And let's assume for a second the appraised value comes in short of contracted sale price. And in this example, let's say $380,000. What happens there? Okay, one of 4 dispositions must take place, and in no particular order. Disposition number 1, either the listing agent or the buyer agent or a combination of the two want to contest the appraisal and go through the rebuttal process. Basically what happens here is they create an email and an outline contesting why they disagree with the appraisal and perhaps supplying some more comparable sales that maybe the appraiser missed. If that doesn't work, disposition number 2, again, no particular order, the seller reduces the contract sale price from $400,000 down to $380,000. An addendum to the contract is circulated for all parties to agree, and the loan continues forward. Disposition number 3. Let's assume for a second that the buyer and the seller agree to meet somewhere in the middle. In this example, let's say the new contracted sale price would be $390,000. Okay, so that would mean the seller reduced $10,000 from the original contracted sale price, and the buyer increased $10,000 above the appraised value. Once again, an addendum is circulated, all parties agree. Disposition number 4, if that doesn't work, let's assume for a second the seller says, I am not budging, I want $400,000. And the buy side or buyer says, I want to go ahead and continue to purchase. What happens there is the buyer gives authorization and in writing to the lender that they're willing to pay $20,000 above appraised value. Okay, now what happens if none of the 4 take place and the lender does not have a clear direction from the borrower? Well, I can tell you right now, the lender will decline the loan due to inadequate collateral not supporting contracted sale price. That's the disposition because there's no direction as to what can happen. All right, so here's where things can get a little jumbled up. All right, but Matt, hold on. They're putting down 50%. How could they possibly get declined? All right, let's go back to the original mortgage application. Remember, the borrower is applying for a 50% loan to value, meaning a sale price of $400,000 and getting a loan amount of $200,000. If the appraised value comes in at $380,000, lending goes based off the lower of the two, either the contract sale price or the contract sale price, now follow me on this, or the appraised value, the lower of the two. And in this scenario, the lower would be $380,000, changing the loan to value. And if there's no clear disposition, the lender has to decline the loan. Now, let's stop there, compartmentalize that, and move over to another question. Matt, they're putting down 50%. Do they still qualify? Well, in that scenario, more than likely, of course they would qualify. They're putting down so much. I can't imagine a buyer not qualifying for a 53 or a 54% loan to value, but qualifying for a 50% loan to value. But that's not the point. We have to go back to giving a final direction to the lender and all parties agreeing. You see, we are in an industry on the mortgage side that is riddled with myth, rumor, and hearsay, and my job, my passion is to give you clear and concise information. I hope you found this of value and together in success.